Today, Governor Lowe and the Reserve Board met for their April board meeting and they kept the cash rate on hold at 1.5%. Now, no surprises there in the lead up to an upcoming election, so only a month or so away from the federal election. Now, I want to start looking globally first, so let's do around the grounds globally. The US market, so there's definitely been some changes and some sentiment shifts in regards to the confidence in the US market, and that's been led by the GDP numbers that we've seen come out of the US. So when President Trump introduced the tax cuts, we definitely saw a bounce in business confidence over there and obviously in business returns and record share market prices. Now, so we saw GDP running at around 4% at its peak. That has since declined. Now, we saw the Q4 result over in the US where the GDP number was 2.5%. Now, if we look back to the Q3 number, the annualised rate of growth was sitting at around 4.3%. So we're definitely seeing a cooling in that marketplace. And that has then also led to probably, the Federal Reserve doing something where they're forecasting or signalling that there'll be no more rate rises throughout 2019. And finally on the US, we then circle back to the big trade negotiations between the US and China. And we've definitely seen that the language weakening in terms of the tough talk that we saw from President Trump is now sort of being watered down, and we're now starting to see some more collaboration in those trade talks. And I think that has also meant that the businesses and business confidence around the US is probably better than it would have been, given that, the US trade heavily and so do China. So it's only good for the world economy. The other mess that we see over in the world at the moment globally is really the Brexit situation that's going on between Britain or the United Kingdom and the European Union. So it's a complete mess, and it's pretty clear now that a lot of people who voted in that referendum probably didn't realise that they were being sold a pup. And now that is coming to play out. So very difficult situation over there. So lots more politics to play out there before we see a resolution. But one thing's for sure, this uncertainty is not good for global growth. So hopefully we can get some type of conclusion out of that in the not too distant future. Now let's turn to the domestic economy. And the first thing I really wanted to talk about is really the labour market. Now, if we didn't have a federal election next month and we were looking at a more deteriorating labour market, we would probably be seeing a rate cut this month, but we don't have that situation. In fact, the February unemployment rate came in at 4.9%. Now that's the lowest in 7.5 years, and it certainly shows that it's not a bad result where we're seeing most people gainfully employed in Australia. But if we look forward and we look ahead, and this is where we're seeing a lot of economists talking about rate cuts, this is our problem. So I'll just explain that. The jobs that we created throughout February were 4,600 new jobs. So that's not a big number. It's an important number to get us down to 4.9, but not a big number. Now, the other bit that I want to talk about is the skilled vacancies. Now, this is an area that we should be looking at because we want people in skilled jobs, higher paying jobs. That's good for the economy, more income coming in, more spending going out, and that grows the economy overall. Now, again, not showing positive signs here. So let me explain this. So in February, we saw the skilled vacancies rate of a negative fall of 0.9%. So that wasn't a great result, but that's on the back of the January data, which was revised down from a positive 1.9% to a negative 0.5%. So that has meant that the annualised pace of skilled vacancies has fallen from a negative 0.7% to a negative 2.7% in February. So that also means that, there's that confidence piece that comes into play. So overall, jobs at the moment are good, but the forward thinking about the confidence in the economy isn't quite there. Let's expand on that further and start to have a look at some of those key drivers in this area. So consumer confidence. So consumer confidence for March, which is the Westpac Melbourne Institute Index, saw a fall of 4.8% in its March reading, and that then moved it down to a reading of 98.8. Now that's down from a February reading of 103.8, and that means that there are more pessimistic views out there than optimistic views, and that has really been led by the surprise GDP decline that we saw in the second half of last year. And that has been that trigger for that concern. So that's what we're seeing in terms of consumer confidence. In regards to the consumer spending story, we turn our attention over to the retail sales for January. Now, we did see a rise in retail sales of 0.1%. Now, consensus for January, given we had such a poor December, was a 0.3% rise, and we just didn't get there. So we were disappointed with that number, and that has meant that the annual retail growth is sitting at 2.7%, which is well below its long-term average of 3.7% growth. So the contributing factors to that have been put down to things like, naturally, the slowing housing market and the wealth effect, general household debt, people being more concerned about maybe paying debt down in these uncertain times, and weaker wage growth. So that is also a story that needs to play out further. In terms of NAB's business confidence survey, we did definitely see a deterioration in both conditions as well as the confidence in the market. So conditions fell from a +7 to a +4, and confidence fell from a +4 to a +2. And both of these levels, even though they still appear in the positive, are below their long-term averages. So that's not also a good sign for the broader economy and for jobs growth. So that's, again, why we're seeing a lot of the economists predicting that we'll see a rate cut inside this year and possibly two. So let's now turn our attention to the housing data, and we did see some interesting data coming out again. So the ABS released their Q4, which is the December quarter data, and that showed a fall of 2.4% for that quarter. Now that means that the annual pace of the national housing market, and remember there's always markets within markets, but the national housing market is negative 5.1%, and that's down from a negative 1.9% in Q3. So we did see a lot of media noise around that story, but remember that is the December quarter. So we are definitely seeing auction clearance rates improving, and certainly what we're seeing in the field with our team is that there's a lot more buyers around. We're not saying it's in the madness that we saw throughout 2016, 2017, but there's definitely in the good pockets there's one or two buyers out there for every property. So we could see a stabilising of the property market. Now that further could be enforced by what Labor announced last Friday, by declaring the date to introduce their changes to their negative gearing and capital gains policy. So we do expect that we will see a bounce in the existing property stock around Australia as people try to lock in their negative gearing benefits and their capital gains benefits based on Labor's policy and based on the assumption that Labor may get into power. So we will see probably a floor inside the property market because of that reason. What happens after the 1st of January is anyone's guess, but we'll talk more about that into the future. In terms of the lending data, just want to go through some interesting lending data, and this is also why I worry about Labor's policy. To give you an example, so in January, owner-occupier and refinancing data for owner-occupiers dropped by 2.6%, and that's the lowest level since February of 2013. Now, if we exclude the refinancing figures, it's down 1.2% or 14.7% year on year. Now, we drill a little bit deeper, and this is why I think the policy is a pup also, and that is that the owner-occupied new dwelling finances has been the hardest hit. Now, that fell in January by 9.5%. So this is off the plan or house and land packages stuff. Now, this is the biggest decline since October of 2008, and it's down 27.6% on a year ago. So you think, well, Labor will fix this because it's going to introduce an incentive to buy new. Problem is, no one wants to buy it second hand after it's bought new. So the reality is investors won't play in this space. So the bounce that Labor is hopefully anticipating, I don't think is going to materialise as people start to understand that the new stock, the off the plan and the house and land packages, doesn't grow in capital growth as well as the existing property stock. So that's something, food for thought, when you start to think about the housing market and what you're going to do in regards to your own situation. And if you're in a position to move forward on buying an existing property now, if Labor gets in, they've still got to get it through the Senate. And I think that's going to be a challenge, because as more and more people realise that it's not necessarily a solid policy and it has problems, then hopefully we'll see some changes to that policy that will be more in line with not taking a sledgehammer to the property market, which is what this policy will do. Now I want to turn to finally budget night. So in terms of budget night, we're hearing from Treasurer Josh Frydenberg tonight, and we're going to see a cash splash. Pretty simple, right? We're going to see a one-off payment coming into people's hands. We're going to see tax cuts, and that's going to be part of stimulating the economy. And I think is another important reason why we saw the Reserve Governor, Dr. Philip Lowe, hold in regards to not dropping the cash rate this month. So he wants to see how these tax cuts will flow through, and then also see what happens to the job market if Labor gets in, which I'll talk about more. So interesting time. We'll see Bill Shorten's reply on Thursday in terms of what their plans are for the economy and where they're going to spend their money. But yeah, definitely an interesting period, which leads me to my final summation and some ideas and my thinking around where I see the cash rate heading. And I've got a couple of scenarios here. Firstly, if the Liberals pull off a stunning election win, an unpredicted election win, I think we will see a bounce in business confidence, and potentially we will maintain strong jobs growth, which will mean if we do have to put one cut in there just to stabilise the property market, that's probably all we may need. If Labor gets in, and given the feedback that we're seeing from the Small Business Council, from also the Business Associations of Australia and all of that, about their concerns of some Labor's policies, I suspect that flows into jobs, and those jobs story could see probably one, possibly two rate cuts. And again, I have that on the back of jobs, and I also have the back of the property market in terms of these uncertainties and the unintended consequences that will come from Labor's policy. So they're my predictions. You can form your own view, but that's basically where I sit when it comes to what's going to be happening with the cash rate over the course of 2019. Thanks for watching, and we'll see you next month.